Hey everybody, thanks for joining today. I'm Kane McGuckin and this is Chip Brackley with Archetype Wealth. And we just want to take a little bit to go through cryptocurrencies as a kind of just the broad space.
So I'll do the intro here, and I'm going to have Kane lead the discussion. Not only does Kane have much nicer hair than I do, but he's also much wiser and well-versed in Bitcoin and the entire crypto world. So I'll just do a quick intro here and then let Kane take it over. Kane and I have been talking about doing a call around this space for a while now, but this is actually the first call we've done. We thought the timing was right. We've been getting a lot of questions from clients, from family, from friends. What is Bitcoin? What is crypto? All of that. And also it's becoming a lot more mainstream. So you're starting to see institutions get involved. Large financial institutions are building out crypto desks, taking positions in crypto. You're seeing on the news billionaires taking positions in Bitcoin and crypto. And you're actually seeing countries now adding it to either their balance sheet or actually thinking about taking it on as their reserve currency. El Salvador being one that is doing this. I think Brazil is also looking at it as well. So it is prime to be looking at it, to be thinking about it. So we want to do this call now. The goal of the call is not to teach you everything we know about crypto. The goal of the call is not to have you leave here and go put it in an order to buy Ethereum or Bitcoin or anything like that. We just want to bring you through, give you a very high level picture of what crypto is, why we think it's so important, and also how we think it's going to change the way we live over the next 10 years or so. So that's really what we're trying to do here. If you walk away from here with more questions than answers, that's okay. That's probably actually a good thing. Kane started teaching me about crypto back in 2017. And I still ask a ton of questions today. You all are probably a lot smarter than me, so you'll get it quicker. But this isn't something that in a 30-minute, a 1-hour video, you're going to get your arms around and completely understand. It will take some time to figure this out. And one of our goals is to get you to walk away from here with more questions. So you either come back to us asking more questions or you start doing some research on your own. So that's kind of where we are, why we're wanting to do this. We're going to start it with a quick 40-second video. Then we'll walk you through kind of a series of slides, but this will be best played if it's interactive. So if your video is on and you have a question, feel free to shoot up your hand. If you have a question and your video is not on, you can shoot in a comment and we'll pick those up and go. But I'm not a huge fan of webinars or these Zoom calls. Usually when I'm on it, within about 10 minutes, I'm scrolling through my phone, either on Twitter or looking at emails, or Kane's got me on fantasy football now. I know Dave Tonoff's a big fantasy football guy, so he'd probably be doing the same thing. So want to make sure that we keep it interactive. So if you have questions and you're thinking something, someone else is probably thinking the same thing. So throw your hand up and put in the question on comments, and let's try and keep it interactive. So we're going to watch a quick, literally 40-second video to kick it off, and then we'll start going through the slides.
I wasn't prepared to translate that as I was doing that little tease.
Oh, that's
that little mark with the A and then the ring around it.
At.
See, that's what I said. Katie said she thought it was about.
Yeah. Oh.
But I'd never heard it.
Around.
I'd never heard it said. I'd always seen the mark, but never heard it said. And then it sounded stupid when I said it. Violence at NBC.
Yeah, I heard around big fight up in the lunchroom the other week.
There it is. Violence at NBC. GE.com. I mean.
Well, Allison should know.
What is internet anyway?
Internet is that massive computer network, the one that's becoming really big now.
So great video there. And hopefully that kind of gives you guys a good picture of maybe where we are today, where we have been the past few years, but also what the next 10, 20, 30 years might look like. So we're looking at cryptocurrencies, we're looking at digital wallets, we're looking at all these things that are new But the thesis and the basis of it is it happens on the internet, and it's built and structured just like the internet that we've all seen play out for 30 years. So it's just really, in simple terms and very broad strokes, just an evolution of the internet. And this time it kind of touches on banking and money, which is one of the last places that has kind of avoided the internet, so to speak. So if you look at, I'll kind of use Bitcoin interchangeably with cryptocurrencies, or there's Ethereum. If you look at it, there's two camps. There's Bitcoin and there's Ethereum, really, when you boil it down and make it really simple. So the Bitcoin camp is kind of focused purely on sound money. We all today, we've seen the printing going on at the central bank level. We've seen kind of the inflation creep in and all those things. And it really stems from unsound money. So you've got the Bitcoin camp focused on the money side of it. And then you've got the Ethereum camp, which is more the innovation, the technology, the growth, the connectivity of systems, much like what we've seen play out from Yahoo to Netflix to Amazon and all that. So there's two different camps. I kind of lean that if you're in one or the other, you probably are being too short-sighted. So, but they interact and play well with each other. So really, if you break it down, crypto, the whole ecosystem, it can be a currency. As we discussed, it can be an investment, an asset class, a digital asset class that's based off data, which drives the world today. Or it can be a technology. It can be the integrations and the components that tie systems that have traditionally been unconnected. It can tie them together and make them connected. So that's kind of a high level of just the broad view of the system. So when you think about it from a monetary perspective and from a money perspective, scarcity is what makes something money. That's what drives that value that you see, and that's kind of the narrative that you see behind Bitcoin. And the importance there is understanding that there are only 21 million Bitcoin. There will only ever be 21 million Bitcoin. And so once those last Bitcoin are mined in 2140, there's not going to be any more. And that supply, the way that those Bitcoin come into use and into the market is mined by software where they just kind of solve a math problem and whoever wins gets Bitcoin. But every 4 years, the number of Bitcoin that you can pull out of that system cuts in half. So you've got a max of 21 million, and the amount of Bitcoin that come into the market each day, each year, each month, each 4 years cuts in half. So there's and also a key point is there's a lot of demand. You're seeing people talk about it. You're seeing people buy and sell it. But roughly 3 to 4 million of all Bitcoin have been lost. They've been on people's computers or phones or whatnot. And you've heard the stories where people have jumped into dumpsters looking for old computers that had Bitcoin stored on there. So not only is that supply capped at 21 million, there's also a pretty large component that has been lost. So that's the demand and supply factors that we all kind of know from basic economics.
So I want to reiterate what he said in the beginning. This is almost like, we're not saying this is the end all currency, but it's almost the exact opposite of what the United States is doing. So the currency, if you look at Bitcoin as a currency, the amount of them is going down, and our US dollars is just being printed with an endless supply. So when you're looking at value of something, do you want something that has an endless supply, or do you want something that is scarce and not there? And I think that's the difference, and that's why it's getting a lot of attention.
And that's the attention you will hear from most people. Personally, I think that's probably the worst thing it's great to focus on the limited supply, but to focus on it as a currency, because there are other aspects of the technology really are what drive that 10, 20 year cycle of change that we'll probably see. So if we go back and look back on what we know, because it has happened, the internet was created in the 60s. It really kind of pushed out to the rest of us in the 80s, early 90s. And really at that time, the focus was, how do we get text on a web page, or how do we share text and data from one place on one side of the country to another side of the country, or one side of the world to another. And that breaking that barrier increased the amount of knowledge that kind of seeped out into the world. And so then that led to peer-to-peer, which was Napster. So when you created that text environment, you didn't think people would want to listen to music or watch videos on the internet or place phone calls on the internet or buy something off Amazon. Those things, nobody thought about at that point. But as every 5 or 10 years, there was this major next wave of something happening on the internet. So we went to Napster, then we went to social media, went to Amazon, we started buying things. And now that level of innovation is focused on banking because that's the last place in our lives where there's a breakdown in communication. And the internet really just, if you really break it down, it just digitizes everything and allows communication to happen open and freely. And that's some of what we haven't seen from a monetary perspective in the disjointed systems across the globe. And so if we just look at it and say, hey, in 1991, if somebody said, just go get on the internet browser, you probably said, what is that? And then, but today, if somebody says, get on an internet browser, you hopped on this call and, you know, or you're out on your boat, on your phone, you can hop on the call. You can take it from anywhere because of that backbone of the internet. So same thing, 94. Well, send me an email. What is that? Well, it gets there faster than the post office. You can interact with it. You can make changes, send it on the fly. So it allowed business to happen faster. And then by the time we got to the mid 2000s, you're like, I can't live without the internet or my email. So around 2015, 2018, that's sort of where Bitcoin and other cryptocurrencies, and now you hear the word digital wallets, that sort of took hold where we're kind of at that, you know, what is email? Let me figure it out. But by 2021, you're no longer saying, what is Bitcoin? You're just Googling it. And after 10 minutes, you kind of understand it. You might not understand it. But if you look out to 2030, that's where kind of we are today. If we look at just the basics of the internet and email. So once we get another 5 or 10 years down the road and products have been brought to market, revenues have been generated off these crypto technologies, it will allow us to be like, oh, I get Bitcoin, I get crypto. It just makes sense. And probably my kids and maybe your grandkids or nieces and nephews, they'll come into a world where a digital wallet or cryptocurrency is no different than an internet browser is to us. It's just going to make sense. So, and if we take that perspective, there's two lines here. The orange line is the growth of crypto users. The white line is the growth of internet users. So today, about 30 years into the internet, there's 4.6 billion users. Right now, today, about 12 years into the crypto economy, there's 300 million users. So if you put those on like basis, crypto is about where the internet was in 1997. So yes, Bitcoin may be trading at $55,000 this morning, and you know it's up from zero in 2009, but it is still early because that cycle of innovation hasn't really reached the companies are being built out in 2020 and 21. The revenues and the products still haven't reached the consumers. There's a handful out there now, but not many. And if you look back at the history of the stock market over 100 years, you see these big boom and bust. And so you have a boom, the 1920s, where this new technology came and everyone was excited, but they didn't figure out how to make it into a product that generated revenues. And so you had this big crash. Same thing in the 60s, the internet was created. It didn't get to us until the 90s. So you have these new technologies come to market. Everybody goes into this craze. And then there's a lull of about on average 13 years, which are these recessions, depressions, those things, because in my opinion, it just takes that amount of time for say, hey, I've got this new technology. How do I bundle it, package it, and sell it to consumers to better their life, but also generate revenues for companies?
So if you, just to put it in numbers, if you look at this chart, we've got about 300 million crypto users right now. There's about 80% average yearly growth. That would put it in 2024, so 3 years from now, at 1 billion crypto users. So we've got, what, call it 7 billion people on Earth. A billion of them will be in crypto. And by 2030, so 10 years from now, call it 9 years from now, if the growth continues, you're going to have close to 4 billion crypto users. So with the growth where it is, the adoption where it is, the number of people using it is just going to be exponential, just like we saw with the internet. In that video, we started with 1992. They had no idea what the internet was. how would we be used 10 years later? Everybody's on the internet, everyone's using it for email. I think we're going to see some of the same adoption levels with crypto, and the number of users will be exponential.
And that's an important point, because we all know it feels like as you get older, your life speeds up. Christmas always gets here faster every year, but when you're 5, it takes 3 years for Christmas to come. Part of that is just technology and the adoption and the pace of change of the world, because technology brings us things faster. And so the big premise around crypto is it brings us connections and communication channels faster than the previous versions of all these technologies. So if we look back, if there's one chart that really drove it home for me, it was this, and it's just something I found on Twitter a couple of years ago. This is the life cycle of technology adoption, basically, and creation in the United States. So IBM was created in the 1950s, 60s. It took to the mid 70s to really roll out, and kind of the 80s, 90s was the core staple of the physical hardware, some software, but mostly hardware. Then you had the software age that built on top of it, the operating systems, the Microsoft Office, and they were the dominant era of software. And also, we'll get back to it in a minute, but it was Linux, which was a free and open source operating system. Then midway through that Microsoft dynasty, you had Google come along that started indexing data and putting information on the internet that you could just search questions and your answers come back to you. Midway through that era, which is the era we are in, and that's also mobile compute, cloud computing, all those things. Midway through that, you had Bitcoin be created in 2009 as a monetary unit, but it's offering a lot of the same technological innovation, this time on connectivity and integration across systems for communication. It is a messaging protocol. All these others are just messaging protocols. So we're just moving into the next era of computing, which is like the third or fourth one. And so the point that I made about Linux came along when Microsoft was the dominant operating system, that thing you logged into at work every day, and they charged a lot of money for it, rightfully so. Well, a guy in his dorm room created Linux, and all these people on internet forums helped him build it for free, just like the Reddit guys that you hear about that are trading these days. And so cryptocurrencies are built very much like that. You'll have some guy that will take a copy of Bitcoin, change some of the rules, and create this new token that allows for this next wave of communication. And they'll build it on a message board or just chatting back and forth building. But Linux today runs pretty much all of the internet. It runs most businesses and corporations. They have Linux servers. So we took something that was free and open source and built by the masses, now drives most of what we use every day in our lives. And so, you know, when you look at companies, we always talk about their market cap. How much are they worth? That gives us an idea of, is one company, you know, from a size perspective, is one better than the other from a size and the amount of money that they make. So if we look back, you can kind of see the same companies that were on this evolution of technology are also here in the market cap of companies. So the time it took for these companies to reach $1 trillion in market cap started with Microsoft and Apple that were sort of on the same path. And it took 40 years for them to become trillion-dollar companies. Then the next wave was Amazon and Google. And it took 20 years, so about half of the time to reach a $1 trillion company. And then now in this next evolution of the crypto economy and Bitcoin, it took 12 years to become a $1 trillion asset. So in computing, there's Moore's law, which says that computer chips will essentially double in speed every couple of years. Well, you see that in that the time it takes to reach a $1 trillion company has halved. And that's because the technology has gotten better, our lives have gotten better, so we demand more of the products. And then here, let's talk a little bit about economies and what drives them and the key resources. So, you know, we're all pretty familiar with the Industrial Revolution, and the key resource there was oil. You know, the companies that got it out of the ground, they made a lot of money, and then they sold it to the companies that used it in planes, trains, and automobiles, which help people get around, essentially help communication happen. Well, as we've moved into the digital age, which is just kind of a fourth evolution of kind of our society, the key data or the key resource is data. So data is the new oil. Our world, our business models, our personal lives operate off data. Your phone operates off data, your email, everything we do operates off data. So the people that control that key resource control the revenue streams and all of that. So we're in this world where these platforms like Facebook control our data, and that kind of helps them monetize and make revenues. But the key thing for the crypto economy is that data can flow on these networks out in the open. So if you're familiar with the cloud, kind of like the cloud, and the only way somebody can access that data is if they have permission. So my data can sit out here, and Equifax can pull down my credit score, or my bank can pull down my credit score for lending if I give them permission. So it brings back ownership to the person who actually controls it rather than some platform, which, as you might understand, that does create some controversy. But all along the way, in all these evolutions of technologies and evolutions of society, there have been controversial periods, but they generally work themselves out because humans figure out how to do things, and they're naturally up and to the right. They're generally positively tilted. So if we get back to kind of that open source and the connectivity of things, the interoperability of systems, wallets, computers, and things communicating with each other, the web is really, there's three iterations of the web. The first one was, hey, we've got text on a screen, you can search text. We're using our TVs as our primary source of information, a little bit on the web. We've got AOL and Yahoo, these platforms that we just really go and look at news. That's mostly all that was there. Then Web 2.0 was like, hey, we need to integrate and connect some of these things, make them communicate amongst each other, and allow people to communicate faster in a more instantaneous method. So you had Facebook, social media, Amazon, Uber. Well, Web 1 version of Facebook was your phone book. Then you had Facebook, which became your phone book, but it also allowed you to post parts of your life, interactions of your life, and connect with people seamlessly versus having to flip pages and find somebody in the P's. And it's like, that's the person. Web 3 will just build on top of that connectivity layer. And so that the data will sit in these networks, and then these tokens will communicate with these networks to drive value for real-time instantaneous systems. So we think that we have real-time, but not in the manner with which crypto will bring. And I'll give you an example. I think it was 2014. And this was kind of a light bulb moment for me. I was watching Game Day, and there was a kid, they were on the Auburn campus. There was a kid that held up a sign and said, "Mom, please send," and he scratched out dollars, and he said Bitcoin, and it had a QR code. By the end of the weekend, the internet nerds in the Bitcoin community had sent the kid $25,000. And all they did was freeze frame the TV and take a picture with their QR code reader and sent him Bitcoin. So, imagine that, like, where you can just send people money without having really systems in place. So that's the kind of, use case that we'll start to see. And, you may not be familiar with APIs or smart contracts. If you own a phone, if you use an app, if you use business solutions today, you're using APIs, whether you know it or not. And all it is two databases communicating back and forth. When you click a button, it tells it to go fetch some data and bring it back. Smart contracts will do much the same, but they will operate in a digital wallet. So you could take something like a mortgage that is not fun. Nobody's ever said they really loved going and buying a house and sitting down and signing 300 pages, and taking 4 hours and trying to have a light conversation with these people. But you have a developer on one side, a developer on the other, an attorney that stands in the middle and says, here's the rules. They code that into a smart contract. And when the first button fires off and agrees that something happens, then money's sent. A house changes title from you to me, or me to you. My bank receives the money, yours sends the money. So when your data can sit in the center here where the hands are, then you'll be able to have your data sit there, and all these other applications can ping it. Hey, can I access this? Can I send this answer back? And that is the value of crypto that's much broader than, hey, what price is Bitcoin, selling or trading at today? Should I buy it? Should I sell it? It's really about the connectivity that it's going to allow.
So go back there for 1 second, Kane. So is this where we're talking about, people say blockchain technology, right?
Yeah.
Which is behind it. Is this where that's really been put to use?
Yeah, because the blockchain technology is just a database that sits in the cloud. So it runs underneath these tokens, and it's secured with cryptography that we created in World War II. And so that information sits there in the blockchain, and people can ping it, people can store it. That's why I was saying Bitcoin is not really just money, it's a messaging protocol. So when you send that value to someone, or you buy and sell a token, it's sent in messages that are put in the blockchain.
So that sounds great. Give us examples of why it's so important, or how would people use it? So you just gave that one, but like, why is this going to be beneficial to a business? Why is it going to be beneficial to a person? Why this technology is so important?
Yeah. So we got the kind of Auburn wallet example. You can imagine if you needed to pay a wall for some reason, you could put a wallet on it and pay it. But one of the more interesting areas, like logistics, a major problem in the world for drug companies is loss of drugs in transit. Who took it? Where did it last? I mean, they have tracking mechanisms, but if you have these QR codes and these wallets set up, and they can verify and timestamp true ownership, true access, who touched it, who were the last 4 people to touch it, then your ability to track happens real time, rather than 8 days later when a pallet of drugs show up at a hospital and a third of them are gone. And you're like, well, where did this thing, it traveled halfway across the country. And we know that like this was the checkpoint and that was the checkpoint, but this is real time. So you can track it. Hey, something's different at this stop than it was before. So it creates these alerts. Another one, and this is really just far-fetched, but you definitely can see it happening. So we're all kind of familiar with electric vehicles and all the news around autonomous vehicles. I mean, we were watching on 60 Minutes a few weeks ago. They've got big rig transfer trucks actively on US interstates, and they're being driven by themselves. So if we enter this world where taxis, fleet, you maybe you don't have a job, but you own like 3 autonomous taxis, and you put a digital wallet on the back seat, and that taxi is hooked up to Google Maps, and it's got all these sensors, so it knows if it has a flat tire, if it needs to get its oil changed, and it drives itself around. If it needs to go do any of those things, it drives to the shop. Meanwhile, it's just picking people up and transferring them, and they're paying that QR code. So you receive some of that payment, and some of that payment is cost to maintain that car. But maybe it says, hey, there's more rides that I could take or drive around to increase my revenue in California than there are in Georgia. So the car just drives itself to California. You've not really done a whole lot. There will be things that you will have to do, but this real-time, instantaneous, connected society will allow you to control that fleet. So that's another example.
Yeah. I think the data one was big too. So when we talk about data, right, that's the new oil. Everyone wants data. If you go on Facebook or you say something to your friend or your husband or wife and say, hey, I like your sunglasses, 5 minutes later, you have an ad on Facebook for those sunglasses, right? So Facebook wants your data. Everybody wants your data, which is allowing us to control this. How does this play into data being so important? Companies want it. I know you touched on it a little bit, but talk a little bit more about that.
Yeah. So if you kind of look forward, the way that societies have changed all the time, there's always that control point, that control mechanism, and the haves and have-nots. And we've kind of seen that with these platforms. They're doing trillions of dollars of revenue a year, a quarter, and they're doing it on the back of other people's data, yours, mine, whoever. Some of that's fine. Like to have a better life, systems know things, so they recommend things. But as we move into this world where technology is wiping out jobs and unemployment rates are just naturally becoming higher, not because of the skill, but because a company would rather put in a, McDonald's ordering system than pay somebody $15 an hour, that we have a little bit of problem. So if you can own your own data and it sit in these networks, then if Facebook wants to access it and you give them capability to access it, all of a sudden they're going to have to pay you part of what they make off of it. So you can generate royalties. Again, these are more far-fetched ways that you could see this play out. Things like, if you remember, I think it was 2017, maybe 18, the Equifax hack. That stuff happens, the Facebook hack recently, that stuff happens because that data sits in a silo. And these people that like hacking companies because they sell that data know exactly where it is. So it's only a matter of time that they breach in. So when the data is up in a network, it's not all in one place. It's just pieces. It's spread out across the network. And the instant something happens is an alert. Whereas right now these systems get hacked. They may or may not cover them up, but generally nobody finds out about it till 6 or 8 months later, if not a year later. So all that data is already leaked out. Whereas when data sits in these crypto networks, the instant something changes because of the way the cryptography hashes the information, it's known. It's known like, as fast as Twitter reports a news story these days. So got a lot of that.
Yeah, I'm going to keep going, keep rambling here for a second.
Oh.
So you can stay on this slide, it's fine. So one of the things that when I think about this is like, okay, I own some Bitcoin, but I can't really use it yet. I mean, you can, but one way I think about it where it's going to be like super appealing to us as Americans is, I want to buy your car. I meet you on a Saturday night and I want to buy it. Right now, you're going to say, I'm not going to hand you cash. You're going to take a personal check from me and let me drive off. So we got to wait till Monday. I got to get a cashier's check. Then I give it to you. You deposit it at the bank. It takes 2 days to clear. So the transaction doesn't go through for 5 days. At some point, I'm going to walk up to you and say, hey, I want to buy your car. And I'm going to be able to move 0.2 Bitcoin into your wallet immediately. The transaction's done. We've taken the bank out of the picture completely. There's no costs. The bank doesn't charge us anything. I don't have to walk into a bank and hope to get a green lollipop when I'm in there. It's done, right? So there's a level of convenience for us on that level. But where I think there's huge potential is in third world countries where they're currently not being banked, right? And so for us, it's a convenience. For them, it kind of changed their life. So if you guys have heard of Jack Dorsey, he runs Twitter and Square, started both of them. So super smart, nerdy dude. He's now spending like 6 months out of the year in Africa because of the banking issue. So can you talk a little bit about how this Bitcoin crypto is going to, one, help change the way people in third world countries, which is like literally 3 billion people, do business, transact, could possibly help their lives in the future?
Yeah. So if you're in a developed world, like most of us, we're in the United States, there honestly is 10 other better ways to pay somebody. We're all familiar with Venmo. That's much better than using the bank. It's much more seamless. But if you're in Africa or some lesser developed country, there's really like banks might not exist for 40, 50 miles, and there may be a den of lions between you and that bank. So you're not going, that route. But now that the internet, we talked about there's 4.6 billion users. So that's most of the world has access to the internet through a smartphone or a dumb phone or something like that. So with that technology in your hand, and you're the guy in Africa, let's just use that example, on the prairie, as long as you have that phone, you can pay someone. So Jack Dorsey or some younger guys, a lot of people are going to these third world countries that don't have access to dollars like you and me, getting them set up with Bitcoin wallets and allowing that transmission, that communication of value to happen for whatever goods and services they need within their community. So it's a huge plus, especially in a time like right now where we have all this inequality that largely is driven by the problems that we have around our current money. So you've got this dollar system where it's divisible by 100, or you have this Bitcoin system where that unit, that monetary unit, is divisible by 100 million. So instead of 0.01 cents, it's 0.8 zeros one, or 7 zeros and one. And so when your money is divisible that broadly, it can help a lot of other people who historically have been left out of the system.
I think another thing on that that's super important is not only does it bank the unbanked, right? So they can do transactions, but a lot of those countries, their governments are a total mess. Their currencies are all, like, if you look at the Zimbabwe, I'll call it dollar, I don't know what it is, but the inflation was so bad, it costs like $1 million to buy a loaf of bread, right? El Salvador is seeing the same thing. You're seeing in Venezuela. So it will essentially take away their currency and allow them to transact business in a sound currency, which they otherwise wouldn't have access to before. And they could never buy anything because their currency was so inflated. Right?
Yeah, and if you go back and look at the charts of Bitcoin over the last 5 years, most of these big spikes, if you go look at the news headline, you will see a country whose currency failed. Venezuela, Argentina, Greece, Italy. All of these countries are having problems because they're basically second derivative to the dollar.
So they're exchanging their useless dollars now for Bitcoin.
This is the first time in history there's been a system where they can opt out and still have monetary access. So this slide here, and it's more talking about early stage technology. When you feel like there's the most risk, it's actually at its least. Here, let me move this. I always fumble it, but when actual risk is the highest, the perception of risk is at its lowest. And when actual risk is lowest, the perception of risk is at its highest. And it's hard to kind of grasp. But when you look at the stock market, so like February 2020, hey, I'm going to buy boats, I'm going to buy extra house. And then a month later, you're like, I don't want to buy anything. And I've got 30% less assets today than I had a month ago. So the actual risk was much higher, but we emotionally felt like there wasn't that much risk at all. In the depths of April of 2020, you didn't want to buy anything. You want to run for the hills. You weren't sure if you're going to have a job, but the actual risk at that point was very, very low because the move had already happened. But emotionally, we felt like it was the most risky time ever. The same thing happens with, this is technology and shows the adoption curve. Early adopters, it's perceived that there's a lot of risk. There is no risk because they don't have a product. They don't have consumers. They're just like playing around with nerdy technology, hoping people are going to buy it. But when you get out here to the end of the curve where, you know, Facebook and those guys sit today, there's a ton of risk. But everybody thinks, well, Facebook is safe. It's the best company in the world. Well, I don't know. They were on 60 Minutes for, you know, massive, you know, misuse of data. Like that's big risk to the overall company. So as you move, like Bitcoin appears risky here, it's less risky. It's only when it gets out in these curves. So there's a mismatch between what we feel and what actually happens.
Where do you feel like Bitcoin is right there on that curve?
We're probably in this region because we're starting to see adoption. And again, if we think back to that chart, if there's 4.6 billion internet users, even if we get half of that, if crypto users at 300 million, you've still got, you know, a 6x to the upside from just a pure user base. So again, just to relate it back to something we know, we all think Amazon's the best company in the world. Between 1997 and 1999, when Amazon was going online to change the world and sell books, which everybody said was a dumb idea, it dropped 90+% twice. Bitcoin, its first few years, dropped 70, 80, 50% a couple of times. But 30 years, 20 years later, we all agree that Amazon is one of the greatest companies out there. So you can see just structurally new technologies that are truly changed. They're 0 to 1, meaning like when that one technology is created, it's a game changer for everything. Facebook was 0 to 1. The internet was 0 to 1. Everything after those 0 to 1 technologies is just really playing copycat. And they're trying to piggyback on that groundbreaking revolutionary change.
Let me say something on that. So I think when Bezos started Amazon in 1997, he was doing the book thing. He had absolutely no idea what he would be doing right now, right? He understood technology, where it was going. I think a lot of that's the same with Bitcoin and crypto is people, it's misunderstood and we have a couple uses for it, but in 10 or 15 years from now, we don't really have any idea what it's going to do or change because people just haven't invented stuff on top of it in different layers. So I think there's just a huge path to different things that can be done with crypto, just like there was in Amazon and no one knew it.
And then the last slide, you hear on the news that crypto is too volatile of an asset and you can't hold volatile assets. Well, there's one secret. If an asset has no volatility, it's worthless. You know, you can see that with the amount of dollars that are being printed. It's not worth a dollar, all that kind of jazz. But volatile assets inside a portfolio. So if you owned Amazon for the last 20 years, you probably think that's your greatest asset. For the last 20 years, it has dropped, I think, 40% at least once in each year. That's volatility. So all this is showing if you own volatile assets in a portfolio in a small amount of way, it can actually increase the returns and have the same portfolio volatility, the fluctuation of the portfolio. Now, if you are over your skis and you own way too much, then that's where it becomes painful. But that's a different position that you talk about with your financial advisor. You make decisions around how that fits in your life. So not really just saying, hey, go throw this in your portfolio. I'm just pointing out the fact that what you hear on the news about this stuff is not always actually true based on the data. So that's kind of, you know, that's really, unless you've got anything else, all we want to say. I'd love to, you know, you guys ask some questions. Don't be shy. Everybody thinks that questions are dumb, but they're not. And most people that are on calls like this have a lot of questions they're very basic. One of them you'll hear a lot is, you know, I don't have $55,000 to buy one Bitcoin or just not in that allocation. The beauty of it is you don't have to buy one Bitcoin. It's fractional, but that's drastically different from, say, what we're accustomed to. If I want to buy Apple, I've got to shell out several $100s because that's what one share is worth, you know, or Google's $3,000 a share. And so the fractional reserve part is a big key. So feel free to take yourself off mute, ask a question if you have them, and we'll hang out for a minute.
Kane will answer the questions.
Let's see, Dave. Dave, do you want to ask a question?
So, you know, my question, you know, would be based upon, you know, the same questions I think I've asked Chip before, you know, like, you know, if there is a, you know, recession, depression, and there's a run on the bank, you know, in terms of crypto, you know, and people lose their faith in it and it's not, you know, backed by gold or the dollar, you know, my basic understanding of currency, you know, that's I just still have those questions. What happens? And so I think that, like, based on this, you know, crypto, you probably want to have, you know, a portion of it in your portfolio, but how much, you know, is a scary thing.
Yeah, that's a great question. And I love that question. It's a deeper question. The thing about money is, outside of gold, nothing backs money. It's faith, it's belief. And if we look at money throughout history, throughout thousands of years, there's been seashells, shark teeth, stones that were 1,200 pounds. And so money is just that thing that we all give value because we believe someone else will accept it and someone else will trade us for some other good or service. So we've seen this play out, in my opinion, in the 30s. Gold was the primary base layer money. It didn't move around the world fast enough. So we created dollars to kind of sit on top, and the dollars were created before, but we tied them to gold, and the dollars were backed by gold because that paper money got around the world faster. it could be transferred, it could be divided, all those things better. We're at that same state today where we're sitting with this money that A, there's too much supply of it, so it's almost worthless. And B, it doesn't move around the system fast enough. And so now we've got this technology, Bitcoin and these other currencies that deliver data, which is the underlying value that people say is worth something in the economy. So people are starting to believe more in that. And worst case scenario, honestly, if the financial system kind of crashed, all assets would crash. We would just have bigger problems, like civilizations would grind to a halt. And there would be a period of time where there was no money. It truly would kind of go back to the Stone Ages where you're, making fires and hunting for animals, and that's your trade would start over. If data still and computer systems fired back up, my guess is Bitcoin would probably be a better money than dollars at that point, because it allows that data to pass along. So there's only one currency that has withstood the time of man, and that's gold. But it's hard. You can't carry around a bar. You can't go to a store and cut off a piece of a bar and hand it. They won't even accept it. So there's that belief system is really the driver. Hopefully that answers your question.
Yeah, and a lot of it is just diversification, right? Since we really don't know how it could play out, own some gold, own some stocks, own some Bitcoin, put it in there, because that's how you hedge out a lot of that risk.
And Dan, I see you got your hand up. We have one more in front of you, and then we'll.
Hey, thank you. I appreciate that.
Dave, are you?
Yeah, let me ask you, can you, is there a way to track the people that are accumulating Bitcoin? I read a couple of days ago, George Soros's fund was buying Bitcoin. Is it regulated where you can tell who the big whales are that are buying Bitcoin?
Yeah, doing your homework there with the whales. Absolutely. Yeah. So those guys, Soros, Paul Tudor Jones, some of those guys, the greatest traders of all time, poo-pooed Bitcoin for a decade. They all jumped in one after the other, Stanley Druckenmiller, right, within the past 12 months. When those guys are getting in and your major institutions are getting in, that's a signal for the rest of us. But what you're asking, with those guys getting in, it kind of, to me, solidifies it. And we all, again, that belief system, the rest of us kind of sit here and say, if they're smarter than me and they're doing it, that's just that human psychology. And the way Bitcoin, there's that narrative that only drug dealers use it and it's not traceable. It's the most traceable form of money known to man. If I was going to commit a crime today, I would go get as many dollars as I could, because nobody knows where they've been, where they came from, who gave them to me, where I gave them. So, but crypto, because it's a network essentially in the cloud on the internet, it is internet infrastructure, it's traceable. And there's a whole nother industry popping up called on-chain analytics. And they can tell exactly what wallet is buying, where that money goes from one wallet to the next. It kind of popped up the last couple of years. It's effectively, for people that are in the financial services industry, it's fundamental analysis. And so most of what you've seen to date is technical analysis, which is what price is it trading at, which to me is interesting, but less relative to those fundamental data points.
Dave, I don't think there's a way to know who's buying it, because these people can buy it in secret, put it on a wallet, take it off the exchange. And so unless they come out and say, talk to a position, yeah, we're buying it, you're not going to know who's in there.
You won't know that that's their wallet. But if they said, hey, I just dropped $5 billion in the market, which they wouldn't say that, and you saw a wallet that bought $5 billion. All
right.
Now, at some point, if they expose themselves, it would be known whose wallet it is. But the point of what you're asking is you can track those flows, the supply and demand.
All right. Thanks.
Yeah, welcome. Thanks for the question. Dan, if you had a question.
Hey, yeah, thanks. I apologize if you covered this earlier. I'm on Central Time and I lost my bearing. I came in late. But So how should I feel about what we read about Guatemala recently? Did they adopted Bitcoin as their national currency? Is that right? And if so, how will their economy affect the volatility of this currency?
Yeah, so it was El Salvador, it was in December. I know I saw Brazil the last couple of days, could be Guatemala as well. I think you will see many of these third world countries hop on board because they've been penalty boxed by US dollars because debts are created in dollars, but they don't have access to those dollars. So it's kind of puts them always on the other end of the stick. You know, if anything, if we know there's 21 million and we know roughly 3 or 4 million have been lost, and there's 18.8 million outstanding today.
Bitcoin,
Yeah, Bitcoin. And we have countries coming on board, and like El Salvador made Bitcoin legal tender, which it's their dollar now. That means there's more demand and supply is lower. So if we just forget about everything in economics except supply and demand, when there's lack of supply and an increasing demand, generally prices go up. There could be lots of other things that happen. It could fail. But if it did become that first use case of currency, that would mean it's even though you may have volatility, the stability of it probably lasts throughout time.
Yeah, and I'll say, so Dan, I think one of the things you might be thinking is, okay, well, if El Salvador says, forget it, we're out, and hits the eject button, does that create or Bitcoin and that sort of stuff? You're now starting to see countries doing it, but also corporations, MicroStrategy, Square, Tesla. These guys are putting Bitcoin on their balance sheet. Most of them saying, hey, we're just using it as a reserve and we're not going to sell or trade it. We're not going to use it. It's a reserve. So a lot of these people are buying it to hold it. That doesn't mean that they will. But when bigger players come in, volatility actually will come down.
Yeah.
Which probably mutes returns going forward because you have less volatility and the risk comes out a little bit when these players come in. And you see, like Dave said, that, you know, the billionaires are in there playing in it now, taking positions. So that might actually bring volatility down.
And who controls supply? I mean, the US government can print more dollars. Who can stamp more bits?
Yeah, the network. So that gets into mining. So if you think about it, the network is made up of nodes. So it's computers that run the software. And then you have miners that do the magic math problem and they race around. So every 10 minutes, a new block is broadcast to the network. And so these miners are racing to do a math problem. And whoever wins gets that block each 10 minutes. And right now, that block has 6.25 Bitcoin in it. So they get 6.25. But it started out in 2009 as 50 Bitcoin. 4 years later, it went to 25. 4 years later, it went to 12.5. And this past May, it went to 6.25. In 4 years from May, roughly, it's just estimated based on that 10-minute time, that will go to 3.125. And so as time, and for another 100 years to 2140. So as time goes on, less and less Bitcoin are coming into the system, and you have more and more demand from countries, individuals. If it turns into a true currency, it's still not fully there, but if it did, and everybody converts to that system, then you've got a lack of supply based on the demand. But we know even commodities like oil, they started out like this. Volatility was everywhere, but then it slowly came down to a usable feature. I think if you focus on it just strictly as money, it clouds your judgment. And doesn't allow you to see the bigger picture of the innovation and the connectivity and the things that it will allow us to do in the future versus like, can I trade this thing and make money off of it? But that's, hopefully I explained.
But is there a way that they can increase that from 21?
No, so the nodes, it's called consensus. So you have developers, Bitcoin core developers that create the software, update the software, make the software. And they do major updates. There was a major one, SegWit in 2017. We just passed Taproot here recently, which increased the security, increased the amount of data that could be held in there without changing the size of stuff, or the blocks. But they would all have to agree. And so back in 2017, a bunch of bankers came in and tried to invade and take over. And the network, the nodes, the consensus said, yeah, no thanks. So the bankers tried to essentially pay off some of the main developers to change the way Bitcoin worked. But the community, the entire network, all the thousands of nodes across the world said, we're not running that version. And so it's truly like the consensus of people and nodes, they all have to agree. And if they don't all agree, then new rules can't be passed forward. And that is a deeper question, but that is exactly how TCP/IP, which is the underlying infrastructure of the internet, was built. DARPA, the Department of Defense Research Department, built TCP/IP in the 60s in that same exact manner. Does that
confuse you more?
That help or hurt?
Well, it's still a little mysterious, but who controls the supply seems like a big deal. And then what's the risk of counterfeiting? Same thing as with other currencies. You know,
yeah, that was so. Bitcoin is not the first digital currency. There was Hal Finney was a creator in the 80s and 90s. Nick Szabo, he's the father of smart contracts. He created a couple. I think Adam Back created one, or I know he created some of the functions that are in Bitcoin. So did Szabo, and probably Hal Finney, but he died in 2014. So it's not controlled by anybody. It's controlled by that group of people and the code. And so the only way to really control it, you'd have to take over all the nodes. And so that's just, it's a math problem, and I forgot it, but it's like going around the sun a million times over. You can't, it's hard to beat. And that's why the governments don't really like it, is because they're used to a money that if something goes wrong, they just raise the debt ceiling, which for the rest of us doesn't really work that well if you're just strictly talking about a currency. I think there was another point that you made, I think I might have missed.
Counterfeit?
Oh, the counterfeit. So yeah, that's why Bitcoin actually succeeded when all these other digital currencies failed, was because it's called the double spend problem. So in this ecosystem, in this crypto ecosystem, these currencies go out and they push back and forth. Well, right now, if I put a picture on the internet, you can snip it and share it 10 times over. So you created an exact replica of that thing that I said that was scarce. That's what kept all the other digital currencies from ever working. Well, so that's what Satoshi Nakamoto, the anonymous individual that created this, or group of individuals that created it, they solved that problem. And there have been times, there was one, I think in 2020, where somebody claimed that they had created that double spend, that they had spent a Bitcoin that was already spent. That's a lot deeper to kind of like talk about that, but that's why Bitcoin actually worked. That's why the community and Bitcoin has risen, and people are so excited about it, because they've got this digital currency that can't be copied and replicated so far in the 12 years of existence. And that's why it's competing with the dollar at this point, if you look at it strictly from a currency standpoint.
Good questions.
Anybody else? No. All right. Well, that's I think that's about all. And well, there's one point you made about the mining and the supply. So basically, the mining of Bitcoin works much like mining in real life, mining for gold. So you got to spend a lot of time, energy, effort getting all these machines and oil and cutting through the dirt to get that tiny bit of gold. Well, Bitcoin, when you do that math problem and you win, it's the same thing. You get that tiny amount of Bitcoin relative to the existing supply. So gold miners I've read where they basically pull roughly 2% of the above ground supply every year. So if there's $10 trillion in gold above ground, they basically can take no more than 2% of that on average each year, meaning bring new supply. The Fed, on the other hand, can just sit here and hit Control P all day and blast out trillions within seconds. And so Bitcoin's designed mathematically to operate with that same supply schedule that naturally happens in the traditional gold mining market.
Okay.
All right. If we don't have any more.
Yeah, this is good. We appreciate you guys being on. And Dan, if some people join late, we recorded this, so we'll have a replay, so you can listen to the beginning if you miss it, or listen again. If anyone has questions or wants more info, be happy to have a conversation or shoot us an email. We can talk further about it. Kane can talk further about it, and I can just nod my head. So
Chip breaks it down. He kind of makes it simple for everybody.
yeah, exactly. So anyways, Kane, thank you. Great job, and appreciate you guys all being on.
Yeah, thanks for joining. We'll leave these slides up. Like I said, if you want to shoot us an email, you got questions or something else you want to talk about, happy to do it at any point. And we'll send out the replay.
Thanks.
Thank you.